Rate hike fears return. Why the Federal Reserve's latest move has investors on edge. Intro. Hello everyone, and welcome back to the channel. Today we're diving into one of the biggest stories shaking global financial markets, growing fears that the U.S. Federal Reserve could raise interest rates again. While many investors were hoping that rate hikes were finally behind us, the Fed's latest meeting delivered a surprise that has markets, businesses, and consumers paying close attention. The central bank decided to keep its benchmark interest rate unchanged at between 3.5% and 3.75%, but a closer look at the Fed's projections revealed something far more important. Policymakers are becoming increasingly concerned about inflation, and many now believe another rate hike may be necessary in the future. So what exactly happened? Why are investors worried? And how could this affect stocks, mortgages, businesses, and even the global economy? Let's break it all down. The Fed holds rates steady. At its latest policy meeting, the Federal Reserve chose not to raise interest rates. On the surface, that sounds like good news. Markets generally prefer stable interest rates because they provide predictability for businesses and consumers. Many analysts expected the Fed to remain on hold as policymakers continue monitoring economic data. Fed officials acknowledge that inflation has come down significantly from its post-pandemic highs. However, they also emphasized that inflation remains above the central bank's long-term target. In other words, progress has been made, but the fight against rising prices isn't over. That's where the concern begins. The dot plot that changed the conversation. The biggest headline from the meeting wasn't the rate decision itself. It was the release of the Fed's updated dot plot. For those unfamiliar, the dot plot is a chart showing where individual Federal Reserve policymakers believe interest rates could be headed in the future. Each dot represents one policymaker's expectation. This latest version revealed a noticeably more hawkish stance. In central bank language, hawkish means prioritizing inflation control, even if it requires keeping interest rates higher, raising them further. The updated projections suggest that a growing number of policymakers believe rates may need to rise again before inflation is fully under control. That single message sent shockwaves through financial markets. Why inflation remains a concern? Many people are asking the same question. If inflation has already fallen significantly, why is the Fed still worried? The answer is simple. While overall inflation has cooled, certain areas of the economy continue showing stubborn price pressures. Services inflation remains elevated in many sectors. Housing costs remain high. Labor markets continue to show strength. Consumer spending has proven surprisingly resilient despite higher borrowing costs. All of these factors make it harder for inflation to return to the Fed's preferred target level. Fed officials appear concerned that cutting rates too soon, or signaling victory too early, could allow inflation to accelerate again. It's a lesson learned from history. During previous inflation battles, central banks sometimes eased policy prematurely, only to see inflation return stronger than before. The Fed clearly wants to avoid repeating that mistake. Market reaction. Investors get nervous. Financial markets reacted quickly to the Fed's message. Investors had increasingly expected rate cuts in the coming months. Many traders believed the central bank was moving toward a more accommodative policy stance. Instead, policymakers delivered a reminder that inflation remains the top priority. As a result, expectations for future rate cuts were scaled back. Bond yields moved higher, stocks faced pressure, and investors began reassessing their outlook for the remainder of the year. Technology companies, which tend to be particularly sensitive to interest rates, saw renewed scrutiny. Growth stocks often benefit from lower borrowing costs and cheaper access to capital. When the possibility of higher rates emerges, those valuations can come under pressure. What higher rates mean for consumers? The impact of interest rates extends far beyond Wall Street. Everyday consumers feel the effects too. If rates remain elevated, or move even higher, borrowing becomes more expensive. Mortgage rates may stay higher for longer. Credit card interest rates could remain elevated. Auto loans may become more costly. Businesses may think twice before taking out loans for expansion projects. For households already dealing with higher living costs, prolonged elevated rates can create additional